So Warren Buffett famously said, the most important job of a CEO is capital allocation. You want to decide where to deploy the firm's resources for the highest return. So in most companies, we assume that happens at the boardroom or in the finance department, the finance department. But in reality, the vast majority of companies' future cash flows ends up being deployed by the procurement team. So folks in procurement aren't just buyers, they're asset managers. And today we're going to take a look why. This is the Rebuild Procurement Podcast, the number one procurement podcast in the world, where we dive deep into topics to keep procurement people up to date and ahead of their peers. I'm Tom Finn, bringing 15 years on the client side procurement, finance, and category management experience in large and small cap orgs. And today we're going into procurement as the capital allocation system. So first things first, we're going to stop here and stop just chasing savings. We're going to start chasing investability. So something that we see within procurement is that they tend to define success as spending less than last year. That's kind of the old, right? Just kind of how do you end up proving your worth by saving those dollars at the end of the year? Where is your value? It's because your company saved more than it planned in its budget, things of that nature. And finance uses a different one. They're looking to beat their hurdle rate. They're looking to have internal return on capital and have it at a certain amount higher than they could just by throwing it in bonds and things of that nature. So as opposed to viewing spend as one where cost needs to be drained, we're going to view it as capital to be deployed. So if you save 10% on a machine, but it breaks down twice as often, 3 times as often, even one more time than expected, you haven't saved money, or the company hasn't saved money, regardless of what's on your spreadsheet or your team spreadsheet. You've end up lowering the return on invested capital, the ROIC of the plant, of the manufacturing line, below that hurdle rate that the team within the company chose to lend at, chose to give the money to invest in. That hurdle rate no longer meets what it was intended to be deployed and do. So you've ended up destroyed value by saving money. So a way additionally to look at some of these things, and just how procurement is the asset manager, the one that ends up dealing with the capital allocation, is IFRS 16, where your contract could also be your liability. So this is something with regards to the embedded leases, and it's a trap that companies fell into. If you just think back a few years ago with Enron, the smartest folks in the room, they ended up having shell games. They were played. They ended up being the ones where a lot of financial regulation ended up being pushed, and they were kind of, they were doing illegal stuff is what they were doing. They were doing stuff. I don't even think it's allegedly at this point, but if it is allegedly, but everything, there was a lot of just things at the time. They had these, I think they're SPEs, special purpose entities, where they were lending themselves money, or receiving money, lending it, then buying their own stuff with that lent money, something along those lines. But that was an extreme version of what an embedded lease was, and procurement might not necessarily be a part of that. But one you might be a little more more recognizable was GE, which was not fraud, but it was some version of shadow debt, which is really what that regulation worked to put in place. So GE Capital, just to use them as an example, they acted like they were essentially a giant unregulated bank that was attached to a lot of industrial companies. And the way they did that, they ended up using the short-term borrowing to fund long-term assets. So They would have this commercial paper, which is short-term borrowing. Over the course of X months, you pay it back, and then you can refinance it. And then they would fund things like plane leases, there's planes, trains, and automobiles, like MRI machines, things of that nature. Super expensive stuff, right? Hundreds of thousands of dollars, millions of dollars. And because how they reported it, which was industrial versus financial earnings, the debt they had, it was unrecognized, it was opaque to the investors that were investing in GE and GE Capital. But then when 2008 hit, right? I mean, the way they were viewed was this: they were an asset-heavy company. They're doing all this stuff with, again, trains, planes, automobiles, and the way that they were presenting it was asset light. Could speak of it as if it were a service, and we'll go into that a little bit, and just how procurement is the capital allocator with a lot of these signatures. So when the 2008 crisis hit, the credit market ended up freezing, right? They couldn't roll over any debt. No one was giving debt to anybody, especially decently indebted companies. And that shadow of the shadow debt was exposed. So the stock, which was GE at one point was the most valuable company in the world, it collapsed. I believe they ended up selling off that division, but there was just a lot of issues that they went through. And they were a really great example of this asset light illusion, where they looked like they didn't have anything on their books. They were kind of just, working, moving things around, when in reality it was financial engineering. And they made a heavy industrial business look like a high margin, software company for like 20 years. So it worked for a while, and it's something that won't work much anymore. Of course, there's always folks looking to get around things, but there was this embedded lease, embedded leases, which was addressed through this regulation, which turned the contract into a liability. So just to use that example of shadow debt, if you just think within your company, so you're the CPO, you're the CFO, your team, someone on your team signs a 5-year agreement for a fleet of trucks. They call it a service fee. When I was in refining, I think everything was tied to, it was $5 per hour, $10 per hour for a truck that was rented. Maybe it was just all in cost, including services. Services maybe was 51%, things of that nature, where you have this service fee, and you keep $10 million of liability off the balance sheet. So if this 5-year agreement for the fleet of trucks, you kept it off the balance sheet, you look like you're asset light and you're super efficient. So that was all fine before. You could do things that way. And then Sir David Tweedy, which was he was a former accounting standards chair. This was it's called the Tweedy evidence. How would you look at these things? And he had joked that he was quoted a version of this where he wanted to fly in an aircraft that was actually on the airline's balance sheet, and he ended up getting his wish, which was this mechanism, this IFRS 16, which has been in place for a few years now, and they've changed. So that OPEX, right, that operating expense, is now considered an embedded lease. And this is where, because these rules have changed, is where procurement can get into trouble, right? I've worked with CFOs, and irregardless of this, they just think if they're going to have to commit to long-term, and then there's going to be a break clause, right? It's even things beyond embedded leases, that if there's going to be any sort of break clause, there's the things you need executive approval on. Need to make sure folks are aware, because the signature is bond, right? There's a majority of many procurement folks have the right to sign a lot of these contracts. So you end up making these long-term commitments, 3 years long, that may have a large break because of the investment on the client, on the supplier side, and really that's just a commitment from your company to pay them in the future, no matter what. So you have to be mindful of those. But just going back to the specific regulation where your contract is a liability, if you have a title contract called like logistics services agreement, for example, it looks like a service, logistics services, but auditors look at what's happening within it, not necessarily just the title. So there's two scenarios I have here. One is if DHL or a shipping company uses any truck to move your goods, so they're just going to commit to doing something for you, it's a service, it's operational. Now, if you instead specify that that fleet is of these certain 50 trucks, potentially you need to put maintenance on them, but if they're just listed out with the VIN numbers and they're dedicated trucks to your company, that's not a service contract. It's a lease in the eyes of your auditors, in the eyes of accounting. And that $10 million obligation, it ends up hitting your balance sheet as debt. And that matters because the many banks have certain triggers, certain covenant triggers the bank covenant to look at it. You can essentially trigger a default if your company's company may be bigger than that, may not worry, but if they're going to end up bringing that onto your balance sheet as debt, that could be a huge issue. And really, then you have your controllers and everyone reading through your scopes of work. But that's one where folks end up getting really, you really have to pay attention and be in line, because that is true capital allocation. Truthfully, you're working with debt or not on your company. So I have two other examples here, just around whether just how procurement is and can be good capital allocators or poor direction of capital. One's going to be our good old friends. I guess maybe let's look at Boeing first. And this is going to be an example of a failure. Unfortunately, Boeing's had quite a few failures of recent. Maybe they're coming back a little bit, but this is essentially good outsourcing part of capital allocation. So good outsourcing can reduce capital, and bad outsourcing can create integration tax and worsen usage of capital. And I've lived experiences of that. So everyone wants to be asset light. It's everyone wants to be a SaaS company. But there is, you work towards the return on invested capital, right? If you're every dollar you're getting in, you're investing, you want to get more on the outside of that, on the other side of that. But there could be hidden cost. So one of those is an integration tax. If there's the cost of getting two companies to act like one. And that I remember working with a really good project manager, and he had just always instilled in me, this earlier in my career, just that the more companies you have working on something, the bigger of a mess it could be, just the more difficult it is to get everyone on board. So for the Boeing 787, mistake that they made was Boeing outsourced the design of the fuselage to save capital, to save dollars, but they outsourced complexity, not execution. So in many cases, the in-house really should be the one figuring out what it is that you want, right? But in this case, they outsourced that. And the tax was this traveled work. So when the parts arrived, they didn't fit perfectly. They had to perform traveled work. So if you fix a rivet at the supplier cost, it costs $1. If you fix it on the assembly line, it costs $10. And if you have to disassemble the plane to fix it, it costs $100. So Boeing paid billions of dollars, from what I was reading, on this integration tax and wiped out all projected savings. So, it's really, it makes a lot of sense, right? Similarly, when you have like the prefabbed homes, if something's going to happen at the manufacturing site, easy, right? Easy to fix. You can tweak things. Just the further it gets closer towards that end customer, and the further along in the design you go, and manufacturing of whatever it is, the more difficult it'd be. If you already throw up all the drywall and everything, then you realize you have to rip out the electrical, or things are just laid out totally improperly, and windows don't line up. Costs a lot of money at the end if you were just to go back and fix it at the job site. And this is where FEL comes into place, and making sure a lot of or whatever the project management philosophy is being used on a project, just where they work through. On the other side is Apple, who just is generally referenced for decent practices. So they're well known for outsourcing execution specifically to Foxconn, and then they keep the interface and the design the module's clean. I mean, it's the Apple product, and the integration tax is essentially zero, right? They use Foxconn as the one that's just manufacturing the outcome, but they're the ones that make sure that everything is perfect, and they hold Foxconn to very tight restrictions and ensure that their design is rolled out through the manufacturing process. So the lesson here on this point number 3, never outsource the interface. And if you do, you'll pay the tax. You could pay a lot more and wipe out all of your savings. So the way to look at this, again, the way that finance looks at it is this return on invested capital, where you have your profit over, like, essentially what you're making, whatever that metric may be, it's helpful to be dollars, over the invested capital, the money that you're putting into it. So most people focus on the profit or the savings, which is on the top. But if you can get deep enough into the project or deep enough into whatever is being built or done, that invested capital side, that's really where you can end up better adding some value. So using Apple as an example, they have a negative cash conversion cycle. Dell was known for this as well. And they end up getting paid before their customers, by their customers before the suppliers pay. So they operate with other people's money. And that's what Dell was always referenced as. It's just they're more well known for it than Apple. I'm not sure if this is on all of Apple's products or not, but Dell was just known for such a tight supply chain that they would just essentially operate on other people's money, which is a fantastic situation to be if you're a CFO, if you're a CEO, if you can collect and from your customers before you end up needing to pay your suppliers, it's optimal. So in summary, we have here, the first is protect the hurdle rate. So the soft savings is a lot of times what procurement folks add on to add value, but you just know the CFO is it's not everything they want. They understand hard work. They appreciate the hard work, but really they're looking at dollars. And you want to frame the negotiation through investability to the extent you can. So think, I was able to preserve margin, keep the project above a certain hurdle rate, supporting that hurdle rate is, the best is if you add both, if you can show both. So you really want to be an integral part of whatever team. In this case, we're talking about this investing of capital. So with the project team, if you could be part of that team, be clear, know what the metrics are, share the metrics, work with finance, and it shows that things matter beyond the savings, right? So you want to make sure that clear. Number 2, treat every contract like it's a bond issuance. Many companies have processes in place, especially larger companies, but not all. And you can really set yourself up for some bad conversations if you don't understand how this shadow debt can end up really hurting a company and hurting its finances, and end up owning debt that you didn't expect to have. If you're going to be in some of these long-term leases or things you may consider a lease, you really have to walk through with finance and understand what could be considered debt and what may not. So you want to treat that pen with the same respect that that your treasurer treats any bond offerings, right, that you're going through. And then the third here, the lessons, all these lessons learned that we get from Boeing. So on their 787, you could always buy parts, which is the execution side, but you can't buy the understanding of how they end up fitting together, which is competence. So you never want to outsource what it is that you're doing and what it is that you're going to be known for. So if you end up outsourcing the interface, you're going to pay this integration tax. Again, that dollar at the supplier site turns into $10 on the production line, turns into the $100 when it's a fully put together plane, because you have to bring everything down, break it down, put it back together. So really, those are the things that you can end up just keeping the complexity inside, understanding what your company is supposed to be great at, Apple, the design, but the building, they can watch over their suppliers and the execution. So you want to send out that modularity and keep inside the complexity. So at the end here, you, procurement, sourcing, teams, CPOs, CFOs, and just any supply chain folks out there, you control the capital, you control the leverage, and we're gonna have a part 3 of this. We're gonna keep these going a little while, I think, for a few more weeks of just walking through the value add of procurement and different ways to think about procurement and sourcing. And we're going to go through liquidity and how procurement teams have a big driving factor on the liquidity of companies. So that's it. That's a pod. And we'll chat next time. Bye-bye.
Show me, and you won't hear the word rebuild.